Let's talk to Marc Ostwald. He's a strategist at ADMISI. Very good morning to you, young Mark.
Good morning.
Right, let's talk about data. Data fascinates me at this point in time. What numbers came out this week that were good, bad and indifferent?
Well, we've had a lot of interesting stories guiding the market this week, which in the end all proved to be incorrect. We had the one about the Bank of Japan apparently being on an exit because they cut their operations earlier in the week for buying JGBs, but it was only the long-term ones, so not in the part which the curve that they target, which is 0 to 10 years. Then they did an operation 0 to 10 years where they didn't cut anything, so that obviously wasn't true. Then we had this interesting story about China cutting back on its purchases of US Treasuries. That was a big influence on the market. But the next day, the FX regulator in China basically told us, I think this may be based on, either fake news or false assumptions about what we're actually doing. And the truth of the matter is, when China's running the sort of trade surplus that we saw published today of $54 billion, that means a lot of that is going to go into their FX reserves, and they may not allocate it all to US Treasuries, but they're still going to have to allocate quite a lot. So yep. I never really quite understood why people reacted to that. In terms of the data points, and that dovetails into today's data points, the most important probably have been the inflation indicators from the US, import prices much lower than expected, and PPI in the States also much lower than expected. And they feed through into the numbers today. So we have been focusing all week on what is this inflation number going to be in the US, given the big debate that's going on the Federal Open Market Committee. And the expectation is that we're going to get a 0.1% rise on the headline, 2.1 year on year. That would be slightly down on last month. It's not disastrous, but it does imply that the measure that they target in terms of inflation, the PCE deflator, will still be quite a long way off. The risks on this, and indeed on the core headline, food prices, which depress both import prices and indeed PPI. Big risk. We had the UN's FAO's monthly food price index earlier in the week. That showed the biggest fall, 3.3% month on month, that we've had since 2015. So it is a lot to do with what we already know, in the sense that this has been very visible in grains prices and indeed other soft commodities. We'll also have a bit of a fall in gasoline prices if you look at the retail gasoline prices in the States. But the more important measure, obviously, is the core CPI measure. That's expected to be up as ever. The forecast pretty much every time we get this number is always 0.2. And that would leave the year-on-year rate unchanged.
Right. The
key elements within this is, A, auto prices. There were a lot of incentives around. So as much as we saw a strong gain in sales, a lot of that have been on the back of discounting, which could serve to depress that core measure. Housing, which has been the element which has kept core CPI very elevated. It has drifted a little bit, down from 3.6 peak last year, down to 3.2%, but it's still a key element keeping that buoyant. And then there's the volatile element that we've got at the moment, which is medical costs. They've been all over the place over the past year in response a lot to some of the measures being introduced by President Trump. And that probably could be the wild card measure within it. In terms of market reaction terms, we do need a number which is above expectations.
Right.
Otherwise, markets will tend to go to the assumption, well, some of the Fed members may be talking about 3 rate hikes this week, but we stick to our view of it's 2. It could be lower. But there is a very big divergence of opinion on the FOMC at the moment, and a lot of it, that will evolve as the year goes on, really depending on how the data actually turns out. Retail sales also on the line today, and that's going to be important in the sense that we are expecting a very strong contribution from personal consumption to Q4 GDP, which we get published at the end of the month. I think the risks here, headline could be a bit weaker, simply because as much as auto sales volumes have risen, this is a value measure, and given that dip in prices, So it could come below the expectation of 0.4. However, as an offset, and probably more important, chain store sales, as represented by the Red Book, up 5.6% in the relevant reading for December, and suggesting that that could actually be quite robust. And so the core measures could actually come in above expectations, reaffirming that expectation that personal consumption is running at a good pace, and reaffirming the idea that if wages continue to pick up a little bit, then personal spending could actually even pick up a little bit more this year.
Final thoughts, markets, on the back of all of these data points, obviously going to be examining them very, very closely. Do you think the markets, okay, have called it right, 3 rate hikes for the year, to the end of the year, equity markets, consensus bullish, markets go higher?
Well, I think the market expectation is 2 rate hikes this year. I think the risk is 3 still. Are they calling it right at the moment? Well, it's very much contingent on what goes on elsewhere to a certain extent. I.e., if we actually find ourselves in a situation where the ECB not only ends, as it's starting to signal, its QE program in September, and gives us an early signal that it is going to end, and as the market's now starting to price in, there's a 75% chance of a rate hike in the Eurozone by the end of the year, then that will basically start to prove to be a bit of a headwind if we've got this situation where the Fed's tapering its balance sheet, the ECB is starting to look at a rate hike maybe by the end of the year, and we get into a situation where wages do start to materially pick up in Japan, which will definitely feed through into inflation there, and it becomes clear that the Bank of Japan will also be starting to enter into a taper, something which I think the markets are a little bit complacent about. They look at the CPI numbers, understandably say they're a long, long way from the target. How could the BOJ could possibly consider that? Well, we'll see what happens with wages, because if wages do pick up rather more materially, then the Bank of Japan will have to seriously consider stepping away. And when we get into that situation, eminently, you're probably going to see the yen strengthen quite a lot, and historically, strong dollar yen is not particularly good for equity markets.